Welcome to the Mortgage Note Podcast. I'm Scott Kimbler. On this episode, we speak with John Hummel and Shelly Kobb of U.S. Bank.
Right before the pandemic, we were in certainly a better rate environment pre-pandemic, but I think we were all thinking that things were slowing down a little bit in the industry as a whole. Then the pandemic hits, rates drop to 3%, 2.5%, and we had a real stretch there between really 2020 through probably 2022, where here at U.S. Bank, we had record-setting volume across really all the distribution channels, whether that be retail or the correspondent HFA business. And then shortly after, the pandemic kind of ran its course, we started to see a real shift in the rate environment out there. And, over the last 2-3 years, I think we've seen probably some of the more challenging times for the overall industry, just due to really a culmination of where rates started to drift up. And then, the continued pressure just on overall inventory levels, across the industry. So a lot of change, I guess best way to classify it is kind of a tale of two cities, right? We had extremely low rate environment during that 2020 to 2022 time period. And now we've seen, elevated rates, ever since, with those continued challenges with the inventory supply.
Now, with all those challenges converging with the higher interest rates that went up really, really fast, combined with the shortage of supply and the increase of demand and corporations buying into communities as well, it would seem this would become more difficult for the borrower. But I have learned that it's still something that folks can navigate. It's just a little more complicated, or has a few more layers than what it had before. What would be your take on that?
Yeah, no, I completely agree with you. And I think that this is a little bit unique with the housing shortage supply, but I do see more houses on the market for longer, prices in some areas dropping. I think from a lending perspective, it's really keeping in touch with past contacts, working with them, keeping relevant, keeping your name in front of them. But it's also educating, who's going to become the new borrowers, right? So really coaching and counseling them in finances and what it takes to purchase a home. It's the biggest financial decision that they're going to make of their life. They still can purchase a home. And that's really a big part of our HFA business, where, the housing finance agencies providing down payment assistance and working with first-time home buyers to help to get them into a home. So where the market interest rates might be, right now for HFA lending, in cases they're lower than market rates, and you're getting down payment assistance, which is really beneficial for, like I said, those first-time home buyers.
To add to that, the other thing is we did have those historically low rate time period. And I think probably early on in, call it 23, the industry was probably more in a shock because it was such a low rate environment. It had climbed up. But the longer that rate environment has stayed elevated, I think, borrowers start to become a little bit more callous to the fact that the rates are higher, because they're going to still have lifestyle changes, whether it be, a family expanding in size, people getting married. I think Shelly hit on the first-time home buyer segment, still probably the largest growing demographic out there. So there's always going to be a need to still do a mortgage transaction. It's not all contingent upon rates. I mean, certainly rates do help fuel the fire at times, but lifestyle changes dictate that people still need to make changes in their home purchase needs.
Now, of course, things were sort of thrown into a tailspin again with the rising rates and the supply and demand and all of those factors, including the pandemic. Do you find that it's leveling out more and people are really becoming adjusted to this new reality? Has it settled down a bit, so to speak?
I think, as John kind of mentioned, that, we've been in this rate environment now for what, 18 months, 3 years?
Right.
Has it gone by that fast?
I think probably closer to 3 years.
Time flies.
Yeah.
So it's no longer that, you're seeing those, really low interest rate, 3% and sub 3. We've been seeing these higher rates now for almost 3 years. So it's really kind of, I think, settling in that it's the new normal, right? So as John said, it's no longer, I'm going to wait for them to drop back down to buy that next home, moving up or relocating, moving to a new neighborhood or new school district. I think that people are now realizing they no longer want to wait, right? It's been long enough. Let's make the move now and, refinance when the rates do drop.
Now, also, I see that U.S. Bank lends in both the retail areas as well as correspondent space and even the ever expanding home equity lender space. And especially with home equity, that affects a lot of our listeners and readers, and also affects me. I'm getting older in years, so home equity is something that I'll be looking at in a handful of years. How has that market shifted and adjusted, and how is U.S. Bank's involvement in that? How's that going?
Yeah, I think it's the focus. There's probably a renewed focus, not just at the lender level, us being that lender, but also at the borrower level. I don't know if the stat is still as accurate as I had heard at one point, but not too long ago, I heard that on average, most households have, on average, about $211,000 of working equity. So if you think about, kind of going back to the housing shortage for a minute, or a borrower that just does not want to pay, at the rate environment we find ourselves in today, they're tapping home equity now to do maybe some renovation and remodel to their existing home. It gives them an opportunity to continue to get more shelf life out of their existing home versus maybe having to go into the purchase market and be challenged with both, elevated pricing, elevated rates. So, and then, certainly there's probably some debt consolidation that's being leveraged as well through the use of home equity.
And are you finding that this is a growing market and a growing need?
I definitely think it is. I think that now that, I think Shelly alluded to it, now that people have kind of come to the realization that we're in this rate band, maybe it's not 7%, but it's some rate band of, 5.5% to 6.5%, maybe for the next year or two. Maybe there's more of a focus on, how can I leverage and tap into my existing equity in the home I'm in, while they wait for maybe the purchase market to improve a bit, whether it be inventory related or rate related.
Do either of you find that when you have various metropolitan markets across the U.S., where are you seeing, like, let's say, the most growth now, and where are you doing more business now than maybe in the past?
I would still say that some of the hotter markets out there are, the Southeast. There's a lot of building going on in the Southeast. So that's one area that continues to, I think, show pretty good growth trends. But you still have big production coming out of the likes of places like Texas, California. Florida for a while was really hot, but that has since cooled off a bit, mainly because of probably taxes, insurance, and unfortunately, a lot of the natural disasters that have hit that state in a short period of time. But I would say the Southeast seems like it's probably one of the more sustained growth markets for the last few years now. There just seems to be a lot of population movement into that area of the country.
And do you find that there's an adjustment the U.S. Bank needs to make to sort of keep up with these growing trends in various parts, or are you guys well positioned to sort of flow where you need to go rather quickly?
I think we're pretty well positioned. I mean, we're national in scope, but I think one tangible example is, we have a builder business here at U.S. Bank where we work very close to the builders, and so staying in lockstep with them as they continue to build in these different geographies, I think puts us in a pretty decent position to, leverage those growth opportunities in those different geographies.
Both of you are in a position where you're really, I would imagine, watching the figures quite often and watching the trends as U.S. Bank continues to grow and service the consumer. Not necessarily making predictions, because you don't have crystal balls, of course, But what is the sort of projection trend that you were seeing? Because now we're into the second part of 2025 and coming up on 2026. Do you see trends that are developing now that maybe we should keep an eye on, either of you?
I'm not sure that I'm seeing any new trends. I think it's been pretty status quo.
As I look at 2026 or see projections for 2026, I do think that the market is being sized slightly larger than what we're going to realize this year, just due to a projection that maybe rates do ease a bit. But I think to Shelly's point, I think it's going to be a lot of the same. It'll still be a predominantly heavy purchase market. If we do see a little drift down in rates, we could see some refinance activity because of all the originations that have occurred over the last year and a half that maybe are between 6 and 7%. But I would say all in all, right now, early indications show us that next year should resemble what we've experienced a bit this year in 2025.
Yeah, and just to add to that, I think outside of just looking at, mortgage volume and what's, coming, it's really focus on technology and artificial intelligence. So taking the time to really look at, operations and what we have, for our clients to submit loans or to apply for a mortgage. It's really how can we do it smarter, leaner, faster, using artificial intelligence. Like in my business, it's really that review process. So when we have a loan file come in, really looking at AI to eliminate a lot of what was stare and compare and manually completed. For the borrower, it's really being able to go onto their mobile app and to apply for a mortgage, submit loan documentation, do their disclosures through e-signature, and even the closing, doing it from their home almost virtually. There's some changes there that are occurring, and it's really keeping up with that technology.
Now, that must be a challenge in itself, dating back again to the age group that we are in. This is a very fast changing technology. And of course, myself, my parents, and even grandparents would have sat down with attorneys and stacks of paper and contracts and things of that nature. But yeah, with the younger folks coming up, this is really a very different way of handling large transactions.
Absolutely.
It would seem a bit intimidating to people that are doing it further down the line.
I'm sorry, further down the line, can you clarify what you mean by that?
In age and where we are in life.
I gotcha. Yeah, you actually have both ends of the spectrum, right? So you still have a population that wants to sit down face to face with a loan officer to do their application, all the way to I just want to do it in the evening from home, and not travel to an office or not meet face to face. So you have both ends of the spectrum, I think.
And do you find that your industry is adjusting to that pretty well, where you can accommodate the people that want to do it old school and the folks who really have no interest in sit down meetings on that sort of thing?
Yeah, it's part of the reason why, we have loan officers all over the country. And I think that our position is that we will accommodate you based on what your needs dictate. To Shelly's point, there are some people that, they just want to go through our portal and really, self-serve. And yet there are probably still many borrowers out there that really want to have that sit down in person, or some combination even. Maybe they start by leveraging the technology to get the ball rolling, and then as they get closer to really kind of finalizing where they're headed with a transaction, they involve, a mortgage loan officer to really kind of come to that, end game, so to speak.
When it comes to servicing lenders, which of course is your business and to a very, very large degree, what is U.S. Bank and other lenders having to do to continue to go ahead and service the borrowers in a cohesive and profitable sort of way that works for everybody?
So from the correspondent perspective, working with independent mortgage bankers, banks and credit unions, for us, it's really that ease of use, the transparency and communication. So, trying to keep things simple so that a correspondent lender then can apply that within their own business, working with their borrowers. And again, the technology. So if the lender themselves have the technology, we need to be able to take off where they've left off, and really complete that end to end. I think for us, it's again, we have a similar situation to the loan officer structure in retail, having account executives that cover all 50 states, and being in the local markets, and understanding the state nuances, and what that might be, and that can even be the adoption of technology in some of those markets as well.
Going back to both of you within the industry, but also on a personal level, just keeping with you here, Shelly, you've been in this business a very long time. As you mentioned, like 35 years, and you were once a teller at the window. What is it about this business, or even specifically this company, that continues to make the job exciting for you?
I think that while it ebbs and flows and there's peaks and valleys, it's forever changing, right? So you mentioned how long I've been doing this, and I think back to where it was paper applications and copies of documents, and loan files being delivered by courier, and how much it's changed. So I think it's ever changing. It's fast paced. I'd say there's never a dull moment, but when there is, you actually take that in and enjoy it because it picks up again. So I think that's really what keeps me in it. But then it's also, I do take pleasure in the transactions that I see or that I'm involved in, that, really it's like I mentioned, it's that educating and, putting folks into homes. And, to me, that's really exciting, especially if you see them come back a second time and you see them moving up. It's pretty cool.
And how about you, John? What keeps it personal to you?
Yeah, I would probably hitchhike off of a couple of those comments towards the tail end of Shelly's comments. Whether we're in a higher rate environment or a lower rate environment, people will always have the need to purchase a new home, purchase a second home, refinance their loan to put themselves in a better financial position, accumulate wealth through their home. So that's not going to change. The environment could change, but that need will always prevail. So that, to me, makes it exciting. And I think it's also exciting just to continue to see us as a bank and as a mortgage arm to the bank continue to grow our business. I think the other exciting thing as I think about the future is inroads we're making with working with different parts of the bank. An example is we work very closely with our private wealth group. They're introducing clients that they may be managing their assets for to us. That yields mortgage opportunities. Working with just the bank itself. Shelly talked about her early days in her career. I mean, we're working very closely with our branch network across the country. So, the builder business I mentioned. So there's just a lot of avenues that are either developing or continue to flourish. And I think that gives us great opportunity as we go forward to continue to see some nice growth.
Can either of you add more that the folks may need to know about U.S. Bank or you personally?
Even though we're in 26 states with banks, the actual brick and mortar, we're really in all 50 states. If you think about the business that Shelly supports, she's bringing clients into our servicing portfolio from areas of the country that maybe we don't have a bank presence. On the retail side, we have retail loan officers all over the country in all 50 states. I think the key thing, and I kind of alluded to it in my prior comments, our distribution network is vast and wide between the presence we have from just a pure mortgage perspective across the country, but also, like I mentioned, around work with different aspects of our overall bank. So our distribution center is wide and deep. So that would be one other thing I'd want to just impress upon you.
Yeah, and I think just to further kind of expand on that, you might come into U.S. Bank as a mortgage customer, but having, as John said, the full suite of banking products. Come in as a mortgage customer, you might get a checking account, savings account, CD, auto loan, or whatnot. It really is you can become that one-stop shop, and that's really what U.S. Bank is.
That's a nice way to summarize what you guys do, becoming a one-stop shop. Speaking of which, let's say I am looking to buy, be it a second or third time buyer or a first time home buyer. What does the consumer need to come equipped with when they approach U.S. Bank for buying a home from scratch?
Well, I would say that, first and foremost, I think any borrower, regardless if it's their first home or maybe it's their 10th home, kind of understanding what their home buying needs are, knowing their budget, to the degree they can, having a little bit of education around the market they're buying in. But I think that gets complemented and coupled with, sitting down with a mortgage loan originator and really using that individual as a consultant to kind of complement, the knowledge and know-how they're bringing to the table themselves. So I think that becomes a really powerful combination. They come in, prepared and organized around what they're looking for, the budget that they're looking to try to manage to, and then imparting that information along with the mortgage loan originators, vast and deep knowledge of a given market that they, lend in. So that's what I would say would be the best initial approach if someone's coming to the table to talk to us.
To learn more about the services offered by U.S. Bank, you can work through your own loan officer or begin your relationship directly at usbank.com. I'm Scott Kimbler. This has been the Mortgage Note Podcast.